First off, I want to thank folks who are attending this webinar for spending some time with us today and carving out time of your busy schedule. You know, given this time of year, everybody has a lot of things going on, but we do appreciate you spending a little time with us today. Also want to thank Anthony and Julie over at the New York Real Estate Expo for putting this on and sponsoring this event for us. And with that, we're going to jump right into our podcast. My name is Mike Boggiano. I'm with LendingOne. I head up the commercial originations for the group here. We're based out of Boca Raton, Florida. We are a national lender, so we provide financing on multifamily. My guest today is Anthony Scandariato of Red Knight Properties. He is an investor in commercial real estate, but what separates Anthony and his team from a lot of the owners in the property is that not only does he walk the walk, he talks the talk. He is the investor. He doesn't have institutional money behind him. So it's his skin in the game for every transaction. He's very passionate in what he does. And we've actually done a couple of deals together in the past. It was very successful transactions. Enjoyed my relationship with Anthony, really good guys, based out of New Jersey. Anthony, you want to give a little background about Red Knight Properties and what you and Brian have founded over there?
Yeah. And Brian is my other partner. Unfortunately, he couldn't make it this morning, but Mike, thank you for inviting me, and Anthony and the team for New York City Real Estate Expo. Really appreciate you having me on this panel today. As Mike said, I'm one of the founders of Red Knight Properties, and we can make a long story short because we have a lot of content we want to get through. We are a value-add multifamily middle market real estate investment and management firm with a focus on workforce housing. And, most of our portfolio, Mike mentioned, we sit in New Jersey, about 45 minutes outside of Midtown in Morristown, if some of you are familiar with that area in northern New Jersey. And we have assets up and down the East Coast. Right now, we have about $80 million under management between about 650 units amongst 4 different states. So the lovely sunshine state of Florida, where Mike sits, and then in the tri-state area where we sit as well. So just to make a long story short, that's what we're focused on.
Fantastic. You mentioned that your portfolio size, you guys got started right before the pandemic, correct?
Yeah. So the quick snapshot too, I used to work for a Class A office real estate operator for about 6 years before really taking the plunge into the larger commercial deals. So kind of on the side over those 6 years, I was building up a part-time portfolio, kind of a weekend portfolio, I like to call it, and buying 2 families. And, I met my partner, Brian, so we bought a 10-unit together. And then during a couple-year period, towards the latter end of my career at the old firm, we bought about 70 units together. So we had a portfolio somewhat built up just between the 2 of us, but we didn't have the deal we did with you, Mike, and some of the larger opportunities. And I forgot to mention that the unit sizes that we play in are anywhere from 50 to 300 unit transaction sizes. So what that means for us is about 5 to 30 million in a transaction size. So, and we're on a deal by deal basis. So we're not fund based. And as Mike said, we have mostly our broader network that invest alongside us in our deals.
Yeah. And typically you guys are you in urban markets, or would you consider them secondary markets?
Yeah, we are. I like to call urban infill. So maybe we're in a suburban area with, a small downtown, and we have some properties there. But I wouldn't say we're, urban focused. We're usually within an hour of a major metro, so somewhat secondary, and we have a little bit of tertiary product in there as well. Like I said, within an hour of a major metro, but most of it is, I would say 50% of it's probably considered suburban.
Great. I mean, given with COVID and the work from home, being, not in the core urban markets, but being in the secondary markets, an hour outside of the major metro area, that strategy probably has worked extremely well for you and your team.
Yeah, we've seen, especially during the height of the pandemic. We own in New Jersey, so we had a lot of tenants relocate from, I wouldn't say necessarily New York, but even New Jersey has urban markets as well. So some of the more urban areas in New Jersey and kind of moved out, westward. And we kind of, I would say benefited from some vacancies that we had at the time when we were renovating, and some of the higher rents that we achieved as a result, and are maintaining as well. So that strategy really hasn't changed. It's just almost you know springboarded a little bit more.
Correct. Speaking of, when you look back, given that we're at the end of this year, 2021, when you look back over this year, I mean, we started the year probably with a great amount of uncertainty where we were heading in the pandemic to where we are today. I mean, there's tremendous enthusiasm about commercial real estate, especially the market and the type of properties that you guys operate. I mean, what have you seen change during the course of the year in terms of product being either stabilized, value add, and again, just even the markets in and themselves that you operate in?
Yeah, I could probably go on for hours about this, but to make a long story short, we've definitely tightened our underwriting standards, and in terms of our collections moving forward, and some of the inflationary metrics that we're putting on some of these rents. Maybe it takes a little bit longer to finish the repositioning process due to supply chain constraints. Obviously during COVID, there was, a period, and there still kind of is a period in a couple of states, including New York and New Jersey, where you really can't evict still for non-payment till the end of the year. So, we're still kind of in that holding pattern, although rental assistance has been distributing, at least for the most part, on our portfolio. So in terms of changes to the strategy, yeah, there's been, I wouldn't say asset class changes. Like I said, it almost perpetuated our investment thesis to begin with, just because they held up so well, and they're continuing to outperform. So I don't think that changed for us. Obviously, the major food groups of real estate, the winners were multifamily housing and self-storage and industrial. So we're, fortunate enough to be in one of those major food groups, and I don't think our strategy is going to be changing anytime soon.
Fantastic. Same question regarding debt and the availability of debt at the beginning of the year, the cost of debt at the beginning of the year, the amount of players, where we were at the beginning of the year versus where we are today. I mean, how has that changed your investment strategy, or has it changed it at all?
Yeah, it definitely changes the way that we look and underwrite deals. Obviously, everybody's aware the debt market kind of shut down for a month or even two during the height of the pandemic, on pretty much all fronts. You guys
honestly,
did, yes. I remember
we
calling
took a
you.
little hiatus until we kind of figured out what was going on in the marketplace, and we came back. But yeah, we're not alone in that regard by taking a little hiatus.
Yeah, and I remember calling you and just trying to see if I can move around my lender and whatnot. So it was a very stressful time, I think, for a lot of people during those few months in 2020. In terms of the changes, obviously there's a lot of pent up capital and pent up demand, which I'm sure you guys had the initiative to dispose, whether it was on your balance sheet or on a warehouse line, put capital to work for 2021. So basically, up until now, there's still a lot of pent up demand from being on the sidelines in 2020, because a lot of lenders kind of, I don't think, including yourself, Mike, I don't think you came back right away. Like, your products were different. Maybe you cut leverage. Maybe the interest rates were a little bit higher. It wasn't like back to normal right away. It slowly took time. And it's basically stabilized. Correct me if I'm wrong, at least on the bridge side at this point. We have all different product lines now, which is good to have, because if one part of lending shuts down, you can kind of tap into the agencies, which fortunately for us, they had they have, and they still are continuing to have, an affordable housing mandate. And we don't necessarily invest in affordable housing, so to speak, but if they designate, I guess, the Fannie Mae and Freddie Mac designate certain areas, certain zip codes that have affordable housing, and they get credits for it. So they have a incentive to lend. So in some of those areas we bought in 2020 and even 2021, were in those markets where we were able to, procure an agency loan, instead of a bridge loan because the bridge wasn't available at the time, or whatever the case may be. So was glad to see more options are back on the table, but we're still being cautious and, just aware of, the marketplace.
Correct. I know you deal with we're not a lender that's end all be all. I know you have several relationships with lenders. We've seen since the beginning of the year from our competition, leverage has increased in terms of as is, as stabilized, and then being able to, and loan to cost. And then interest rates have dropped dramatically during the year. And then we've also seen cap rates are still very aggressive across the board, being that you're in an urban market, a tertiary market, even secondary markets. We've seen that, cap rates have been compressed with rising interest rates, or supposedly rising interest rates on the horizon. I think you will see cap rates starting to creep back up, and then that will obviously affect the ability to debt service properties, and then the overall valuation of properties. That's our perspective on it. I don't know if you feel any different about it.
Yeah, I tend to agree. If you're, an operator that wants to be prudent and diligent, and when that does happen, obviously we're in an inflationary market as well, so you should be able to hopefully I don't want to say recapture, but kind of pass along, the increase in the rates, in the rents, and kind of stabilize your asset to where it was before. But if you were buying in 2020 or 2021, and you got locked in rates in the threes, or anywhere from 3 to 4, I mean, you're pretty good, I would say. I mean, my philosophy is next year I don't think we're going to see huge, rate hikes. So probably be maybe 1 or 2, maybe a total of 50 basis points. So I don't think that we've seen that before, and it wasn't that long ago, right, Mike? So,
Correct.
And so to me, that's almost better because from my perspective, from the operator perspective, you have in the market, there was an influx of buyers as well that just wanted to buy because the interest rates were low and whatnot. I think you're going to see a little bit less competition and a little bit more seasoned operators coming out and kind of taking advantage of the less competition on deals, because sometimes I'll look at a deal and there'll be 50 bidders on it, as opposed to before the pandemic, maybe it was 20. So I think it's a good thing as long as you take advantage of it and you just be smart about it. And you need to have that perspective that rates, every time we underwrite a deal, we know rates are going to rise. We'll do cap rate expansion, sometimes 200 basis points over a 5-year period. So, it's just the inevitable. We've been in cycles before, so it will happen.
Yeah, it will happen. I mean, with real estate, it's very cyclical. Rates will go up, rates will go down. Occupancy levels will go up, occupancy levels will go down. Those are very good points. You mentioned that you guys, you focusing on workforce housing versus affordability, and there's a big difference between the two designations. But with COVID and remote working, how has that really impacted because you operate in different states as well. Different states have different regulations. How has COVID impacted your business model in terms of being able to do evictions, and then you see and your ability to acquire more properties, because there's also a foreclosure moratorium through the agencies? Is that different state by state for you, or do you guys look at it globally and assess your business model based on that?
Yeah, I mean, for us, we looked at it in moving forward, at least on a state by state basis. I'm pretty aware of some of the outstanding moratoriums right now in the states where we invest. And then if we're considering another state to invest, of course, we're going to look at that. So in terms of how it affected us, kind of getting back to before in where we operated in some of the states that had really strict and still do eviction moratoriums, like New York and New Jersey. we were able to still maintain a healthy occupancy rate and healthy collection rate during the pandemic. But it wasn't easy. We understood a lot of tenants who were struggling, and we worked out payment plans. And, as of this point, if they couldn't pay, they either voluntarily left or they did pay, or rental assistance backstopped it. I'm actually starting to get court dates. I actually have one tomorrow, which is like the first court date in a very long time for non-payment. I have one tenant that hasn't paid for since March of 2020. So you can imagine what she owes me. Rental assistance didn't come through. So I would say, though, with those situations for us, owning, 600 units, I can count it on one hand how many tenants are like that. So when you look at it across the board or portfolio, it's not terrible. If I had one property and that was the case, and I had 10 units and 5 of them haven't paid, that would be a disaster. But we haven't seen that. So I think I kind of feel bad for, the mom and pops that don't really know how to navigate some of the tenant relationships and eviction moratoriums, that maybe own, 4 to 10 units, and they have, 4 of them not paying. Some of the larger, more, I say sophisticated operators have been okay. Obviously this is going to end in New York and New Jersey. I think they're both at the end of the year. So very, very interesting to see what will happen kind of with the backlog.
Gotcha. Anthony, I know you are a very, very hands-on person from just our relationships and doing lending transactions. So it's no surprise to me that you have a very low percentage of non-payers, because I'm sure you're very proactive in terms of being in front of your tenants during this whole process. So that is good news. I mean, you're correct with the mom and pops. It's basically a part-time job for them, and for you, this is your passion. This is your livelihood, and you can see it in terms of how you operate. Talking about how you operate, part of how your investment, you syndicate in terms of bringing in limited partners and other investors into your transactions. Can you just go over the basic structure of somebody who's interested in moving on up in the asset class, or even getting into commercial investments, and they have limited equity and they need to raise additional equity? How they go about that through the syndication process? I mean, I know we can spend hours on this conversation.
I can make it short. But so essentially, yes, we do syndicate for the most part, although I still buy some personal deals with a couple parties and whatnot. But syndication basically just, you're combining financial resources together to buy larger properties. So we generally use that route, but we didn't use that route until we bought personal properties on our own. We went through a couple properties full cycle, and then we started to syndicate, because you're really bringing on partners, you're bringing on investors. So that model for us that I cater to, we probably have an active maybe 90 investors now in our opportunities. Sounds like a lot, but it's really not. And 90 investors, but they're mostly working professionals like you and I, Mike, that have $50,000 sitting around, whether it's in an IRA or in cash. And typically they're looking to get into passive real estate investing and build their portfolio. And for us, I think it's better to work with them to make individuals more wealthy than an institution that's already wealthy. So I like to cater to that investor base. Obviously it comes with volume and scale to do larger deals, to have more investors, but it's still a good investor base to cater to, in my opinion. And like I said, the way it works is we're combining resources together, and then we're splitting the profits. Obviously, we're operating and we're managing. The limited partner or passive investor doesn't have to do anything. Just basically, we send emails every month, kind of updating our investors on the property, distributions every quarter, so every 3 months, and we do pay them even during the value add process. So we've been able to maintain that for the past couple of years. So that's essentially how it works in a nutshell. And I have a lot of other information on my website, which we'll talk about later.
Gotcha. I mean, you have to have a successful track record and able to be able to attract investors. I mean, you have 90 individual investors, and that's a fair amount of investors that will come back to you guys for investment opportunity when you have syndication opportunities. So you have to have a successful track record in that regard.
Absolutely. I would say it hasn't hurt. I've seen, we didn't have a track record on our first deal. I think that was the deal I did with you, Mike. But we were still able to put it together, given my real estate background, et cetera. But I've seen operators with very little track record get things done, but they only do one deal, and I never see them again on the face of the earth. So you have to close, and like we talked about before, you close your deal and you have to execute on your business plan, because otherwise, you're not going to have investors that are going to reinvest with you. So so that's the repeat investors. Yes, we do have a lot of that, and then we do have a lot of new ones that come in as well.
I mean, you mentioned before that you do value add transactions. Part of it is obviously repositioning the asset in the marketplace, but along with that comes the ability to raise rents. So I'm sure that the yield that your investors have realized during the course of their investments has probably far exceeded their original expectations.
Yeah, we like to underpromise and overdeliver on our underwriting models that we're presenting to ourselves and our investors. And we want to be conservative with our underwriting. And yeah, every deal so far has outperformed, which is obviously great for us. And we still set the expectations pretty reasonably. So when we blow it out of the water, then everybody's happy. But yeah, our motto is underpromise and overdeliver.
Gotcha. And as we mentioned before, I mean, we've done a couple of transactions together. As a lender, we underwrite the property and the borrower, but more importantly for us is we need to understand borrowers' exit strategies in terms of transactions. We're indifferent. I mean, how do you typically exit out? Is it through a sale or refinance? And how does that impact the individual investors?
It depends upon the deal. I typically look for a refi. We've been doing a lot of refinances lately, just because rates are so low, and we're able to return everybody's capital that put in originally, and then as long as it's still cash flowing, similar to what it was before, and you can get return of capital, then for us it makes sense. And I'm a young guy, and I'm kind of building a portfolio to eventually, obviously, sell. Not going to hold forever, but it's kind of building a company as opposed to buying this and then flipping this, and then see you guys. Here's your 40% IRR, and that's it. And then you never talk to them again. So when we do some refinances, I usually like to have a project lined up after that. If they want to reinvest, they come in. So I've been doing, I'd say 90% refinances. I sold one, we're actually selling the property right now, and I sold another property later in 2020. So definitely interesting to understand which strategy makes sense per deal.
Gotcha. We got about another 5 minutes left, so we can have a couple more questions that we can go through. I always love to ask this question from an investor. What is your best success story that you can share with the audience in terms of acquiring and the overall performance of an asset?
Yeah, like I said, we were just talking about refinances and sales. The one that I did with you, Mike, that was excellent, and we refinanced that. We're holding it, but that one, basically doubled in property value over the 16-month period that we owned it. So that was our first syndication, and we blew it out of the water for everybody. And obviously, those investors are very happy, and we're very happy. And we've kind of continued to redeploy that capital that came back and attract more. So I think that one, your first deal shouldn't be your best deal, but that has been the best so far. And that, to me, wasn't really my first deal anyway. So I would say that the one I did with you, Mike, the first deal we ever syndicated so far has been the best.
Well, thank you. We were very happy with the performance in that. There's a little background on that transaction. It was an underperforming asset. It needed to be repositioned. You had secondary income or potential secondary income coming through garage rentals, which were being underutilized in a storage space by the previous owner. And then you also had a couple of retail spaces on the property, which never had a track record. You guys saw through that to be able to say, hey, highest and best use on those units was really to convert them into additional multifamily. And then you started charging for the garage spaces that the previous owner was just basically was, free storage space for the tenants. And you increased the value of the property by increasing the revenues there. So it was a tremendous success story for us as well as for you. And it performed. I mean, for a lender, if we get paid off on a loan, it's a successful loan.
Yes, no, absolutely. We're very happy with that. And you're right. It was 3 retail and we converted them to apartments. We had to go, that was a pain, but we got it done, went through the town to get variances and site plan waivers and whatnot. So, but we got it done all, within our budgetary capital improvement budget as well. It wasn't over budget, and, it was very poorly managed, and, long-term ownership is like who we like to buy from. That individual, it was an individual, that's a key too, owned that property for, I don't know, 15 years. I don't think he had any debt on it. And, that's what we like to buy. That's who we like to buy from, that archetype, investor seller profile. So that made sense to us.
And for the folks who are interested in seeing that transaction, it is up on Anthony's website. You'll be able to visit Anthony's website and see not just that transaction, but his other successful transactions that they've completed to date.
Yeah, appreciate that.
And I know we're running really close, but if you had to give some advice, or even say, if you had to pull out your crystal ball and say, okay, what's 2022 going to look like for you, not only for you, but for the real estate market?
Yeah, I mean, 2022 is going to be, I think it's still going to be strong. And like we talked about before, I don't think the rate hikes are going to be, it's going to be really detrimental. If rates, long-term rates kind of go, in my opinion, above 5%, like on an agency product, then there's going to be a correction. I just don't see that happening. If we're still going to be in the mid fours, it's back to 2019. That's where we were before. And there's definitely going to still be a slowdown. Like I said, less buyers out there. We still, at least in my space, have a supply issue especially in the markets where we're operating on the workforce housing side. Not enough, product to build, to meet the demand. And then the new construction is too expensive to build for workforce. So there's a problem with that too. So I consider the multi, I consider the storage and the industrial to still go very strong into 2022.
Gotcha. Okay, I think we're just about at the end of our presentation. We're not taking Q&A during this presentation, but if you do have questions or you want to reach out to Anthony or I, you can get us our contact information, which will be readily available after the presentation. Just reach out to us. We're both available. We'll take calls 24/7. Anthony's an entrepreneur. Again, as I mentioned at the beginning of the call, he has skin in the game. He is an active investor. He is an active owner. And you find in your dealings with Anthony, he's very passionate about what he does, and it comes across in everything that he does. So,
thank you, Mike. I really appreciate the kind words. And again, for inviting me on this panel, and Anthony for having us on this expo. So really appreciate both of you.
Okay. Well, thank you everybody for spending a little time with us today. We do appreciate it. Have happy and safe holidays, and we look forward to doing business with you remainder of this year and into the future. Thank you.
Michael, Anthony, thank you so much. And Anthony, you definitely sound like you know it all. So you were great. You guys were both great.
That's not a good thing, but yeah, thank you.
But you're really well spoken, and you guys did a
Anthony.
great job. Great presentation. Take care, everybody.
Thank
Bye.
you guys.
Thank you.